welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Interim Director Rob Knapp, and it's great to have you with us this morning. Last night, as you may have heard, was the State of the Union address. This morning, consider this our State of the Economy address. The State of the Union address comes to you once a year. We give you the State of the Economy once a month. We don't have the president this morning, but we do have our chief economist, Gerald Cohen, who will be speaking to you in a moment about the new jobs number, which is solid and above expectations. I know you've heard that before. Last night, things were pretty lively in Washington. They may not be as lively this morning because Gerald is not running for re-election this year, but he does tend to become pretty enthusiastic about economics. So I don't think you'll be bored. Thanks again for joining us. Give you the rules of the road here before we get started. We are going to talk for 15 to 20 minutes. Gerald will give you the analysis of both the jobs number and the economy. Then he's going to take your questions. After that, we'll go for about 30 minutes. If you want to ask a question, you can do so by using the Q&A function, the center of the bottom of your screen. We do go ahead and put press questions to the front of the line. So if you're with the media, please give us your title and organization with your question, and we'll be sure to prioritize. If you're joining us by phone today, you can still get on the phone and ask a question. You can email it to me at rob_knapp@kenan-flagler.unc.edu. And again, we're going to go about 30 minutes. We'll try to get all of the questions in that we can. You can ask one anytime during the briefing. If we get one toward the very end, we may not be able to sneak it in, but we will try. So that's everything you need to know. It is time to bring on our chief economist, Gerald Cohen, who is going to talk about the job numbers, talk about the job or the economy, and not run for re-election. Gerald, how you doing this morning?
I'm doing great, Rob. That was quite an introduction. I mean, I don't know how to think about an analogy between myself and running for president, but I'm just going to call the data as I see it, and we'll go from there. And I do hope that we have a lively discussion about economics, not about politics. And we already have a Q&A, I see. So. Let me start and share my screen. This was it was an interesting report. When I wrote the title "Going to Extremes," I think I still think that the data is suggesting that we're going to those extremes, and what I mean by that is by saying the economy has outperformed, and this data is generally suggestive of that. And as a result, you're going to see less Fed less Fed easing. And I might even say there's the probability of Fed tightening. There was a bit of a mixed picture and some downward revisions to previous months that make it a little bit less solid than you might imagine, and I'll kind of talk through that. But the headline number of job creation of 275,000, as you can see here, was above expectations. And expectations were about 200,000, so we're 75,000 above. And as the chart illustrates, in the 3-month, the orange line is the 3-month average of job growth. We're seeing an acceleration rather than a deceleration, which is what the soft landing camp and the recession camp, or the soft landing camp, would want to see. And also, if you're in the recession camp, then this is going against that trend. Notably, though, the previous months were revised down by 167,000. So if you take the stronger than expected and the revisions, then the job number that we got for February was actually weaker than expected because of those revisions. So the level of payrolls was weaker than the number you would have expected if you didn't have the revisions and you had 200,000. That's if you add the set plus 75 and minus 167. Still that upward trend. is suggestive of a positive of job of a healthy or strong number. And as I've mentioned multiple times in the past, we would demographics should give us about 100,000 job growth, so we're well above the number that demographics would suggest. Now, this is where the unemployment rate comes in, and the payroll numbers, where you are seeing the number of people entering the labor force and job creation from that side. So there are two surveys that are done during the month. One of payrolls of firms, the other one are households. And I'm sorry, this is the household number that we're seeing, where the household survey, where the unemployment rate comes from. And what's notable about that is that you saw a tick up in the unemployment rate to 3.9%. We're up a half a percentage point off of the low 3.4%, which has been the cycle low and a multi-decade low. And my friend Claudia Sahm has created this rule called the Sahm rule, in which if you see a half a percentage point gain versus the 3-month average, and that's why this is important, of the where we are, of the kind of average of the low, the 3-month average low, then that's an indication of a recession historically, because the 3-month average was not 3.4%, but 3.5 or 3.6%. We haven't triggered the Sahm rule officially, and Claudia has been saying, I'm not sure it works this time because of the dynamics of the labor force. But we have seen an upward trend in the unemployment rate. And what's notable is that there is a difference in the employment numbers between the payroll and the household. In the household survey, we actually saw a decline in employment. And we've actually seen a decline over the last 3 months. In the payroll survey, in this chart, we've seen a gain in payrolls of an average of 265,000 over the last 3 months, that orange line. So this difference is quite notable. The one thing I will say about it is that in general, the payroll numbers are more accurate. The household numbers come from a survey of about 60,000 households. The payrolls come from a survey of 400,000 job sites, or 600,000 job sites. So the survey is substantially larger on the payroll side than the household side. But there are some data differences that one might argue that sometimes the household survey at turning points may be a better indicator. So this is where the kind of the mixed picture comes in. Strong payroll number, weak household number. Which one do you believe? And all I'll say as a typical economist is I don't think we have enough data yet to know which one to believe. Somewhat related to the household number, the labor force participation rate it actually declined for the overall number, but actually rose for the prime age. But that prime or working age population has stalled out. So the question that comes is that this raises is where are we going to see the workers to fill those 265,000 jobs per month that we've had over the last 3 months. So that's and if we can't find those workers, then you're going to see upward pressure in wages, and that's the kind of concern that you're going to get to show you. The concern that we'll have upward pressure in wages, which will feed through to inflation. So the latest wage numbers were moderate. You saw just 0.1% gain in February, and that 3-month annualized trend, which popped up in the previous months to over 5%, has now moderated. But we're still growing 4.3% over the last year, which is well above inflation. And whether this feeds into inflation is a question of margins or productivity. And I'm going to go into the productivity numbers in a second. Before I do that, I wanted to show a trend about hours. So one interesting thing that you've seen as illustrated in this chart is that while we're having strong job growth, the number of hours worked per worker per week, or per worker per week, has been on the decline. It edged up to 34.3 hours per week in the last data, but there had actually been and there were upward revisions in the January number. It had kind of shown a bigger decline. So you've seen the trend doesn't look as bad, but what we're saying is we're having more workers, but yes, yet they're working fewer hours. And this is a question of whether businesses are cutting overtime. And so, this trend is kind of, again, a mixed picture. Yes, we have more people, but they're working fewer hours. And that combination is illustrated in this chart, where they take workers times hours, and you get what this index of hours. And you can see that it's been on kind of a downward trend. Again, the last month popped up, and these hours numbers are ultimately the most important thing when you're thinking about GDP, that and productivity, which I'm about to get to. So where does this all add up to? In the January briefing, I talked about three scenarios for the Fed. One in which the economy continues to grow at 3%, which is basically what we've been seeing, and inflation remains at 3%, which is basically what we're seeing, and that suggests the orange line, which is that the Fed should actually raise rates. Then there's the kind of soft landing scenario, which is illustrated in the blue line / black line. The black is what the Fed had predicted in their December forecast, and then there's the mild recession camp, which is the green line. Now, since January, though, the contrast has widened. So what's happened is you're seeing that this model of the Fed, called the Taylor rule, suggests that the Fed should be tightening more and easing less, either in the soft landing scenario or in the mild recession scenario. And that's because of the strength of the data and the strength of inflation. As a result of this data, you've seen a substantial shift in market expectations. And so the green line is what the market expected the Fed funds rate to do over the course of this year, at the very beginning of January. And the orange dot line is now what the markets are saying as of this morning, following this data. And you've seen that the markets are still expecting the Fed to cut rates, but much more slowly and much less in general. So, the markets were expecting, cuts in the spring. Now they're saying maybe not, and the amount of cuts has declined. So why is that? And as I said a little bit ago, that we've seen the inflation numbers come in a little less benign than the soft landing has expected. I've talked about the kind of sticky inflation. That's a measure from the Atlanta Fed about inflation that is, kind of that remains in the economy rather than kind of structural, more structural. And you're seeing that kind of pass through into the inflation numbers. And this is the core PCE, which is the Fed's preferred measure of inflation. And the 3-month annualized trend has kind of stopped going down and is actually moving up. And year on year is, in the mid to high twos, or low. And so that's me all suggesting that inflation, that this last mile problem, that maybe we're not going to get to 3%. To the Fed's 2% that quickly. And a key culprit of that is housing. And the blue line is the year-on-year change, which is still running at around 6%. And the red bars are the monthly change annualized. So that monthly change is over 6% as well, for the month of January, the latest data that we have. So this is one of a key reason why inflation remains stubbornly high. and we've talked about housing shortages before. And so the question is this going to continue? And note how during this period of very low inflation, this housing inflation was running at around 3% rather than the 6%. So it's double the rate. I talked about the strength of GDP, and I want to explain why this matters so much. So you have GDP, which, as I said, is kind of, or as you can see in this chart, is accelerating. And then the issue is, well, what does that mean? And the best way to think about this from my perspective is how GDP fits into the amount of slack in the economy. So this chart is illustrating the output gap. What the output gap is showing is the amount of slack. It's an estimate from the Congressional Budget Office of what's the potential of the economy, and then I added the GDP number and say relative. So the CBO has a potential GDP, and I say, where is that GDP relative to the potential? And a number above zero says that we're actually that we're resource constrained. A number below zero says we have slack. And so you saw we had a big amount of slack in COVID. We've kind of come out of that. It's kind of wiggled and waggled around zero, and now we're above it as the economy outperforms. And the latest data, and one of is suggesting that we are resource constrained, and or Q4 numbers and the strength of Q1. This is through the fourth quarter we have data, but if we see what is expected, 2.5% in Q1, that number will rise. Will continue to rise, saying that the amount of resource constraints is increasing. And that feeds into this Taylor rule model, and is one of the reasons why if you the amount of easing, if you're in the soft landing or the recession camp is less, and the amount of tightening, if you're in the economy stays strong, has increased. So what's the limiting factor on this, or what's the factor that could get us out of trouble? And it's two things. One is hours grow more quickly, the kind of blue kind of bar, or we see a big gain in productivity. And there's an open question these days about whether we're seeing an acceleration in productivity, which similar to the mid-1990s, and interestingly, that was the last time we had a soft landing. Productivity kind of saved us. We had strong growth, but productivity was really strong. So the blue line is illustrating that productivity has picked up. But the question is this a secular increase or a kind of cyclical increase? And you could see that productivity, there's a lot of wiggles and waggles in productivity. But I'm a student. If you ask anybody that knows me, I'm obsessed with productivity. And so I want to kind of leave you by illustrating this trend of productivity. So I've gone back and gathered data to 1889 on productivity, and you could see that there are these distinct trends of high and low distinct periods of high and low productivity. And the one that I was talking about, the mid-90s, in 1995, you saw a big jump in productivity. You saw this jump in productivity that lasted for about 10 years to 2004. Since 2004, we've had a period of very low productivity. And that's despite the iPhone, despite basically how mobile our technology has become, we've had very modest productivity. So the question is, are we now, and you can see these trends run roughly 10 to 20 years. And what I will say is, as a student of productivity, we don't know why these trends change. There's a famous quip by Robert Solow, who's the father of productivity research, that in the 1980s, computers are everywhere but in the productivity statistics. So we actually finally saw computers in the impact of computing power in the productivity statistics in 1990, in the mid-1990s. But why did it take so long? Because computers were on our desktops in the 1980s. And so the question is, are we seeing a reacceleration in productivity now? And probably not because of AI, probably because of other interventions or inventions, technology changes in the economy. But if we are seeing this productivity gains, then the economy is more likely to sustain this growth. If we're not, then it's going to be a problem, and you're going to see more inflation. And I think this is a big debate. I believe this is a big debate that's going on at the Fed at this time. So let me stop there. Leave it for 10 minutes of questions. I can go a little longer because, as I am, as everybody knows or people may know, I love talking about the economy. So
That's that enthusiasm we were talking about. Thanks very much, and I can attest. Gerald is crazy about productivity. So yes, absolutely. We do have some questions in the hopper. Let me remind you, if you do have a question, use the Q&A function at the bottom of your screen. If you're with us by phone today, you can email me a question, rob_knapp@kenan-flagler.unc.edu. All right. Lauren Osorge at the Triangle Business Journal called first today. She was in early with this one. Can you break down how the labor numbers are shaping out for women in the Triangle region?
So Lauren, I will say in the 30 minutes that I had the data, I did not focus on the triangle data. So I'm going to have to get back to you on that. So I apologize. I was too focused on the U.S. Numbers, but there were employment numbers for the triangle, and so I'm going to take a peek at them and then get back to you. So apologies for that non-answer, but I just didn't have a chance to look. It's a quick turnaround.
Yes, like every briefing, we have a long way to go and a short time to get there. So can't put it all into 30 minutes. Another question, and this is back to average weekly hours. Someone asked, was the low average weekly hours for January perhaps due to weather disruptions?
So that's a good question. I did not. I need to check I did not see anything about weather. There is one of the things that you have. There's been a discussion about January is seasonal. The way that we measure seasonal in the data, and what I mean by that is, January is generally a month of layoffs for employers. You hire, I mean, on average, what happens is retail hires a lot in November and December, and then they lay people off in January or potentially at the end of December, but those numbers are captured in January because the data is actually a survey done in the second week of the month. So between the second week of December and the second week of January, you'll see the layoffs in January. And so there has been some discussion about whether the seasonal but you don't want the numbers. You don't. I mean, if you're always saying, well, employment declined in January, and you know that it declines every January, you want to kind of adjust for that. And so the government, what we call seasonally adjust the data to account for January is going to be a weak number. And the question is, and there's been an open debate about, because of changes in hiring trends, especially in retail around the holidays. Now there's much more online shopping where those seasonals are not being measured correctly. So that's I didn't look at the weather, but I did. There has been a discussion because more focused on this question about seasonals than the weather.
Okay, great. Thanks. Interesting question, interesting answer. Another interesting question. Business applications and formations have remained elevated above historic pre-pandemic levels. To what extent will this contribute to the productivity jump over the coming years?
So this is a great question, and I'm going to point everybody to one of our distinguished fellows last year, John Halterwanger, is professor at University of Maryland, is the kind of father of the business formation statistics, and he gave a discussion at the Kenan Institute and you can actually see it in there's a video about it, about business for applications formation and exactly making this link. So there, or saying that there is this potential link. So what you've seen is this big jump following, like basically following COVID. We had seen business applications falling, and we a pre-COVID this kind of downward trend, and we were saying, this can't be good for entrepreneurship and productivity. And at the same time, we had this weak productivity trend, which you can see in the chart that's still up. And by the way, the mid 2010s was the worst. I mean, it was literally productivity was flat during that period. It was terrible. And so when we saw this jump in the after COVID, the question was, has there been this big? Have we seen are we seeing entrepreneurship flourishing, or are we seeing just kind of people saying, look, I no longer, want to I want to be more flexible in my work choices. And so therefore, I'm going to start a consulting company. And I'm not saying that that's not entrepreneurship that leads to productivity, but it could be just that that's more about trends in people's decisions about work-life balance. And so it is a really positive, but I hate to kind of say this, but it's too early to tell whether what this means to entrepreneurship and productivity, because we don't have enough data to say. I hate to say this, but a year from now we'll know a lot more.
So stay tuned. Tune back
Yeah,
in a
stay
year,
tuned.
and we'll circle back on that one.
I want everybody to stay tuned every month.
Yeah, that's true.
But I think, if when you talk about productivity, it's probably more about a year than a month.
Right. Good point. Don't wait a year before coming back. Absolutely.
Exactly.
David Carroll asks, any thoughts on the extent to which remaining unspent stimulus continuing to drip, maybe flow is a better word, he says, into the economy is driving or distorting economic growth, stubborn inflation, et cetera?
Yeah, very yes, and I've illustrated this in previous months that that based on my read of the data, and there's an very open debate about this. We still have a level of excess savings. I haven't done the math, but I think it was close. The last time I looked at was close to 500 billion to $1 trillion in excess saving relative to what we would have seen without COVID. So so this is a something that is keeping consumers healthy and confident. And in general, consumer balance sheets are healthy. You have seen some numbers of debt numbers have increased. The New York Fed had some data. Remember this week or last week that suggested that that debt has increased. We've seen some delinquencies, but overall, household balance sheets are still quite healthy. And one of those things about the health is this excess savings, where people just didn't spend money in COVID. People didn't go on vacation. People we were sitting at home, and yes, we were buying things, goods, but most of our spending is on services, and we actually still haven't recovered in the services relative to that trend. We're well above trend in goods, and so I think that we still have some excess saving. It's dwindling, but by my estimate, it's still there. And even when it kind of gets close to zero, that doesn't mean that household balance sheets are bad. It just means that they don't have that extra cushion that they did, a year ago or so.
Okay, very good. Thanks. This is going to be last call. Adil Faruqi from NCDOT was reading my mind because I had the same thought. He says, though the job numbers are above the forecast and revisions amount to 167,000, what is the likelihood of February numbers being revised? And since the aggregate number of jobs in the past 2 months is lower than previously estimated and unemployment rate up, don't you think these numbers are dovish for the Fed?
Well, thanks, Adil. And I had the honor of meeting Adil in I think in Fayetteville when I was there last week. And I think that this, predicting revisions is a challenge. I mean, I think this is, what there has been, and I noted this a number of months ago, that there has been a trend of downward revisions. And I will say I am still in the ultimately, and we're going to get a recession camp, and that ultimately is not 5 years, within the next 5 years, but I think within the next year. I'm still worried about that, and I think these downward revisions are troubling, but they've not been a great indicator, because despite the downward revisions, we're still seeing very strong job growth. So perhaps this is, putting perhaps when the economists at the Fed look at this, they're going to say, well, there's still this downward risk out there despite these strong numbers, and they'll point to the payroll numbers, the household numbers, where you've seen 3 months of downward, job losses according to that data. They might point to these revisions, but I think we really have to wait until next month to know that. I would say I do not feel I don't feel comfortable forecasting the monthly payroll numbers. Forecasting the revisions is even a greater challenge. But I think it is something that's important, and something to watch. So.
Okay, good point. All right, I'm going to sneak in a lightning round question here from Dan Barkett at NC Business. What do you think the Fed will do with the balance sheet?
Good question, Dan. So I think that we've seen, and this goes back to September 2019, that banks want to maintain a lot of cash reserves. And so I think the idea that the Fed is going to shrink its balance sheet back to kind of pre 2000 Great Recession, 2008 levels, when the balance sheet was $1 trillion, and that's when I worked at the Fed. And helped manage the Fed's balance sheet. That's the world that we were thinking about, where banks manage their reserve really closely. I think there's a realization that banks want this extra cushion, and we've had two experiences in the last 15 years of the Great Recession and then COVID, where banks will say, you know what, I don't mind having those excess reserves. And by the way, the Fed is paying interest on those reserves, so they're much less of a drain. So while I think the balance sheet is going to shrink, it has been shrinking. I don't think we're going to get anywhere close to where we were relative to pre-COVID. And I'd say and I don't want to do all of this relative to the size of the economy, because as the economy grows, just people's demand for money, even though everybody now lives in a Venmo, Zelle world. But generally, when we talk about money, we talk about the kind of broader money that includes electronic. People's demand for money is higher. So, and that just goes with the way spending, because people spend money, so more activity, more spending. And so I think that we're not going to get anywhere near those kind of pre-Great Recession levels, because banks have just shown that they don't want to be there.
All right. Thank you very much, Gerald Cohen, for your insightful analysis as always. Another fun, exciting, and fast morning on the briefing. Thanks to everybody out there who attended and all of you who asked questions. As always, they were great. I'm going to go ahead and sprint through the rest of this so we can get you all back to your Friday. For those of you in the media, we'd love to continue the conversation. If you'd like to speak to Dr. Cohen or any of our other experts on any of the topics we cover in our translational research, you can reach out to me, Rob_Knapp, at Kenan-Flagler.unc.edu. We ask all of you, hey, take a look at our website. We have a lot of great stuff on there. We're putting up some new things today. There's plenty to look at, including the American Growth Project, including our Grand Challenge, which is about business resilience. Lots to see there. We are at kenaninstitute.unc.edu. Thanks again for being with us today. We hope you'll be back in April when we do this all over again. Have a great Friday.
Thanks, everybody. Take care.